Hi, everybody. My name is Kopia Georg, and I'm a professor at the University of Cape Town, where I teach on fintech and cryptocurrencies. I hold the South African Reserve Bank Chair in Financial Stability Studies, but the disclaimer that I always make is that all the views expressed here, especially when it comes to central bank digital currencies, are my own and not those of the South African Reserve Bank. I'm very excited to talk to you this evening about universal access to central bank digital currencies and just tell the community a little bit about the work that we have been doing at UCT as part of my working group, because I think we are one of the newest UBRI nodes and we are very excited to be part of this community. And what I really want to do is I want to share sort of a financial plumber's view on central bank digital currencies. I've been involved with several central banks in designing systems for central bank digital currencies. So what I want to do is I really want to give you this sort of view on what's happening, what are the key decision points that central banks are currently dealing with when they talk about CBDCs, and then take one of those issues that central banks are trying to address, namely the one of universal access, and to show you some of the things that we've been building over the past couple of months, and especially with the hackathon now, we took it to a whole new level. And hopefully the demo gods be willing, just show you a little bit of what we've done and what we can contribute to the debate about universal access to central bank digital currencies. So without any further ado, I want to start with a couple of decision points that central banks are currently debating when they talk about central bank digital currencies. And I'm not going to talk about the obvious one of a tokenized or an account-based CBDC. Most of these systems, most of the decisions that I'm outlining here, you can have both in a token-based or in an account-based system. The discussions that I've been part of have always been about token-based, but there's a very strong selection bias. I think that the work that I've been doing always ropes me into the token-based world. It doesn't mean that that this is the way the world is going to go. And in fact, I would be cautious to say that just because the majority of projects around the world is currently looking at token-based or is undecided, actually vast majority is undecided, but among those who are decided, there's a small majority still doing token-based models. I'm not sure that this is going to be the model that ultimately dominates, and it has a lot to do with who the other players in this ecosystem are. In particular, large financial institutions, consulting firms, payment systems integrators like Visa, MasterCard. They're all active one way or another. And most of the time, what used to be in a centralized financial system wants to stay in a centralized financial system. So the decisions that I want to talk about are really more about whatever you use as an underlying technology. What are the design decisions you have to make irrespective almost? There's some that are more token specific, but these are really CBDC universal irrespective of what exactly your model the model is you're using. And the biggest discussion that most central banks that I've been dealing with are facing is how do we design the system so that on the one hand we have existing financial institutions like banks that still have access to our central bank facilities, to the payment system, to the ledger. And at the same time, we incentivize competition so that new participants can enter. These payment service providers or licensed service providers, however you want to call them, they are really sort of why people are excited about CBDC. And when I talk about CBDC, I should really say retail CBDC, because that's what I'm involved in. So there's from this overview of our and Burma, there's this sort of this dichotomy between two different kind of CBDC architectures. And the first is what I would call intermediated or indirect CBDC, where you have these licensed service providers that have large balance sheets, potentially very large balance sheets. And in essence, they are issuing a payment instrument that can be tokenized or can be account-based, but they are issuing it directly to the end user. So the end user gets a legal claim on the licensed service provider. They have large positive balances, so they have a large asset side. This large asset side needs to be held in some form or fashion. Maybe ideally with the central bank, but maybe in government bonds or other highly secure assets. And if things go very wrong, you hold them in risky credit lines to other crypto companies. But for a regulated system, this is really about giving these LSPs access to the central bank facilities, even if they don't have a banking license, because very often these LSPs are small, relative to the banks at least, small entities serving a specific community particularly well, usually a community that has been overlooked by the traditional banking system. So the CBDC here is a claim on the intermediary. The intermediaries take care of all the onboarding. They execute all the retail payments. The central bank operates a wholesale payment system. It can be an existing RTGS payment system. It can be a net payment system. It can be a rapid payment system. It can be a wholesale CBDC. Like, all of these things are possible, and all of these are being explored one way or another. And the central bank in the system has an intermittent record of end user transactions, where they don't see exactly each individual transaction, but they rather see balances at the end of the day when the licensed service providers do their reserve management. There's advantages to this system. You put everything in the KYC and the transaction monitoring into the hand of the LSPs. You give them a very easy business model because they can float. CBDC in many settings carries no or little interest, while the assets that they can invest, especially if they are allowed to invest in government bonds, carry more interest. So the spread is something that the LSPs can pocket to make a living. But it also means that the central bank has no sort of visibility of the transactions per se, which might actually, on the other hand, be something that is desirable. The main issue with this model, in my perspective, is that it forces the LSPs to have large positive balance sheets. And this is in contrast with the hybrid operational architecture, where the claim of a user is really directly on the central bank. It's a central bank liability like cash. And the LSPs, they really mostly facilitate interaction with the central bank. And they make sure that all the KYCing is done, that that the wallet management, the key management, all of this is done properly and efficiently. And nonetheless, they just help the central bank to maintain their ledger. The advantage for the system is that these LSPs can have large balance sheets if you want to, but they don't have to. And I'll revisit this particular design choice when I talk about open versus closed loop systems just now, because in the system that you have before, what is happening is that all these payment service providers, they're trying to create their own little ecosystem where they're competing for customers, where they try to find mechanisms to have customer CBDC holdings to be as sticky as deposits are through loyalty programs or a variety of different initiatives. While in a system where everybody has an account directly with either an account directly with the central bank or holds tokens in a wallet on a central bank operated or central bank supervised ledger. In this model, you don't have that enclosure. You don't have this sort of competition for just having users and trying to make them sticky. In fact, user deposits can move, user balances can move very easily between the different licensed service providers, much easier than deposits. So we think that this might be a more competitive system, and it makes it much easier to deal with the licensing for the licensed service provider. So I think this model is the more attractive one. I'm not sure that this is the model that is going to win out. I see a very strong push for the indirect or intermediated model, most notably from entities that want to be intermediaries in this model. So that really gets central banks to the decision: do you want to create a closed or an open loop system? And again, it's not a trivial choice because there's benefits to having a closed loop system. But what we try to tell central banks is you have to make a choice. Do you want to build Facebook or do you want to build the internet? And so nothing personally against Facebook, but it's a very different system from what the internet is. And the internet, when you look at how it was developed back from 1969 onwards, there was a time where it wasn't clear that we would end up with this globally interconnected actual internet as we know it, because different internet service providers, different network operators created their own little networks. And they were, in the beginning, very often not compatible with one another. And it really was the genius of the folks who designed the TCP/IP protocol to ensure that interoperability between different applications, and it's sometimes shown in this hourglass figure of the TCP/IP stack, that sort of applications on different levels can easily interact through a standardized bottleneck in this hourglass with all the different physical connections that you can have on the other end. So on the top end of the system, you have openness, and on the bottom end, you have openness, and the two sides are interoperable because there's this layer in between that is tightly standardized, tightly managed, that was not open for commercial use until 1994 when NSFNet opened up, just in time for the dot-com boom and bust. But these design decisions, they had far-reaching implications to ensure the interoperability of the network as we see it today. If you create a closed-loop system like Facebook did, you create all these little walled gardens that are the heart of tech companies, and maybe they are the future of banks. Markus Brunnermeier has a recent paper that talks about it. There's a study coming out of the ECB around the changed nature of financial services in the euro area, where we see this trend towards increased digitalization. The number of employees at banks has been going down for many years. Number of bank branches has been going down. In fact, the number of banks in Germany, where I'm from originally, has declined by 2/3 since the 1960s. So there's this long-term trend towards less bricks and mortar, more digital banking services, even in relatively old countries like Germany, which is even more so the case in a young country like South Africa. The advantages of the closed loop system is they are less complex. They're cheaper. They are cheaper to operate. They are easier to roll out. It's not clear whether they are cheaper for consumers because this lack of competition will eventually demand its toll. But that's a question that central banks are faced with at the moment, and it's a question that is hard to communicate about with central bankers because they are not used to thinking in technology history terms to really understand what the design choices that we are making today mean for the financial system of the future. It often comes from a very different perspective. So it's useful to condense it down to this lens. Then the third big decision that every central bank is facing is: do you prefer auditability or privacy? Cash protects privacy. I mean, it's not impossible to trace. You can watch someone withdraw from an ATM and then follow him, but it's very expensive. So it's difficult to trace, and it protects privacy very well, which is one of the reasons why, especially in the informal economy and emerging markets, it's quite popular. If you have a segmented system, a segmented electronic system, a legacy system, this still provides pretty good privacy protection because you have all these different walled gardens that are not perfectly interoperable. So even if one of them has a data breach or whatever, doesn't necessarily mean that the entire system is compromised, which is one of the risks with a central bank digital currency, where you have to have some level of centralization, either on the KYC level or on the ledger level, for a variety of reasons. So it's a much more centralized system, which is the flip side of being interoperable. I don't mean centralized in the sense of there's one operator controlling the ledger. You can still have a distributed ledger in a system that is centralized in the sense that everybody can come and play on the same level playing field, as opposed to having to play in these walled gardens. The token-based CBDC, that's an efficient and cheap alternative to the existing payment system, but it provides much less privacy. In fact, getting privacy into a token-based CBDC is extremely hard. So there's a couple of flip sides to these points. The first is cash is very costly. The cost of cash in the euro area is around about 2% GDP. In South Africa, it's 1 to 2% of GDP. So it's I learned the other day, if every South African taxpayer would actually pay what they owe, the effect on GDP would roughly be as big as getting rid of cash, in terms of order of magnitude. So it's a huge boost to the economy. The same goes for the legacy system that provides pretty good privacy, but that has all these legacy rails, most notably card rails. They cost around half a percentage point to 1 percentage point of GDP. They are inefficient, and in order to deal with the privacy issue of a token-based CBDC, there's sort of 3 solutions that I've seen. The first is you split the KYC information, your customer information, from transaction data. So the licensed service providers need to be separated from the node operators, need to be separated from the central bank. And you decentralize the system in that way. In many countries, that's not possible, trivially, because you have a central source of identity. In the US, luckily, it's not the case, but in many emerging markets, you have that. You can also separate the ledgers by the amount transacted. So you can have a low value ledger where only transactions up to $10 can be done. But for this ledger, no KYC could be required. And I have to say, this is not trivially consolidated with recent regulation. And you can try to use sort of privacy protecting ledgers, which is usually not feasible just because of the scalability that you need. The ledgers that can handle the nation state payment system need to provide between 1,000 and 5,000 transactions per second on the lower end. And for token-based CBDCs, that's just a tall order, especially if you want to implement any sort of privacy protection. So I'm going to be super quick here just to show you that these costs are really borne by consumers. So some of that is borne on the left-hand side is the distribution of the cost of, and most of that is borne by merchants or consumers. The same as with the distribution of the costs of card. Most of that is borne by the retailers, and obviously it translates into higher prices. When you then dig deeper into where exactly do these costs go, it's ATM machines and the merchant service fees that make up the majority of these costs. So it's extremely costly, and a CBDC would provide a nice, cheap alternative. So that gives me to the 4th point, and that's the one that I want to spend the remaining like 13 minutes on. That's the discussion between functionality and inclusivity. It's very difficult to get a universal access CBDC rolled out in an emerging market because in South Africa, at least, roughly half the population does not have a smartphone. And that is not to say that there aren't a lot of SIM cards in circulation. There are, but these are feature phones that usually cannot access apps or the web or anything like that. So you can SMS and you can call on these phones, but you can't browse. So that rules out almost all private crypto by design, because it's impossible to do the key management. It's not impossible, it's the wrong word, it's too tough. It's very, very difficult to do the key management properly on a feature phone as opposed to a smartphone. But the market for CBDC is going to be huge. So the challenge that arises is, how do you create universal access to central bank digital currencies in a way that literally everybody can have access to that? And we have a solution that I'm going to show you just on the next slide. But to really drive this point home, in many countries, the digital gap is larger than the financial inclusion gap. So it's usually tougher to find people with smartphones than it is to find someone with a bank account. The problem with centralized solutions is they can't guarantee the privacy of your keys, because any centralized API can be secretly replaced, and they can run, malicious code instead that intercepts everybody's keys, especially if that other side of the transaction comes from a feature phone. Then a lot of features that you want in terms of functionality, so the key recovery, two-factor authentication, search by name, where you find somebody else by their name or phone number rather than by their address. That's not possible in the existing system, which in systems with feature phones only. So this severely limits functionality. The way that M-Pesa and others have been solving this is that they create a source of trust themselves and then avoid the problem altogether. So they are not really solving. So what we did is we created, and that's the last part of the presentation, we created a digital asset wallet for the digitally excluded. And there's no good solution. So the least bad solution that we could find was using trusted execution environments to protect user privacy, which allows us to create a commitment device and not just promise users that we will not intercept their private keys. We can actually prove it to them through the code that we are running, and the code can be verified as part of SGX. Now, there's a lot of downsides to it. And I'm happy to talk about this in the Q&A if we have time at the end, or if you want to engage further, just ping me. But it is a way to solve this problem so that at least we, as the system operator, don't necessarily need to have access to your keys. So it allows us to facilitate a system that is a little bit like the Uber of money. And I hate that analogy in a sense, but what it does is it allows agents, connectors, how we call them, that do have a smartphone, to act as micro intermediaries between the majority of people who don't have smartphones. So if you live in a rural community and you don't have a smartphone, you can create an account on the Nautilus Wallet. You can print out a QR code, and when you want to initialize a payment, you can go to one of those connectors who interfaces with our trusted execution environment. So it's not something that runs on the smartphone. It's something that runs on our system, so that we can prove that keys are not being intercepted, at least not centrally. And you can initiate payments, and it gives you a full range of functionality that you can, including search by name, that you can use to create access to digital assets. And you can do this for central bank digital currencies, obviously for all private crypto, for non-fungible tokens, or what we are very excited about are digital rights tokens, where you can extend the trusted execution environment to facilitate data analytics over private data without loss of privacy. There are limitations. Obviously, trust execution environments are limited in memory. They were very limited in memory until very recently. So the challenge that these setups always had was that they couldn't handle enough transactions per second or operations per second to be usable on a nation scale level. Our system, when we benchmarked it, achieves 350 transactions per second per core, which means for a country like South Africa with 58 million people, you roughly need about 1,200 to 1,500 transactions or operations per second, which you can easily achieve with 10 cores, which is still very feasible. The first thing we did when we built the system is we did an integration with Algorand and with their chain, just because I have connections with them. But as part of this hackathon and as part of UBRI, we thought we should be a cross-chain wallet. So we actually integrated XRP with our wallet over the past week. And if all goes according to my plan, I can actually show you how that looks like. So we created this XRPL demo. It's XRPL demo, xrpl-demo.ntls. And please don't go just now. Just let me finish first before a couple of you try this out and the system crashes because it's fragile and it's a demo, and we've hacked it together over a week. So you can go to the website. This is already connecting directly with our trusted execution environment in the back end, so that if you wanted, in principle, you can verify what code we run to handle all the traffic coming from the website. And then you can do the normal things. You can create an account where I can just type in my details, the legendary 1234 PIN. You can create that, and then you then you get the QR code, which you could print if you are one of those agents, or just for the demo, I just copy that address. I go home, I open the wallet, and I can access it via the wallet address. Or if you are on a phone, you can do this by scanning the QR code, which is how we think people will use the wallet most of the time. So you open it, and this unlocks your data that sits behind the trusted execution environment within our enclave. And then the first thing you got to do is you got to get yourself some XRP. So I'm going to copy the the address again, and I'm going to send myself 100 XRP. Okay, only find in a validated ledger. So that should at some point true. So it's validated now. So you can go back to the wallet, which has been topped up, and now you can start sending money. So what we did, we have a second address that we can send the money to, or you can scan a QR code if you're one of these connectors. You type in the recipient's address, and then the backend connects with the XRP ledger, everything behind the trusted execution environment, which is easier than putting the entire blockchain in TEs, which has been done by a couple of companies and projects. So this is a much easier setup. So I want to send 20 XRP just for fun. It takes a little bit to confirm the transaction. Money has been sent, and you can check it out on the Explorer to see that this wasn't just nice looking fake. Find the transaction has been actually applied to the ledger, and you're done. And what we integrated just now is KYC functionality. I don't think I have the time to really demonstrate all of this, but just so you see how that looks like. We've integrated with Onfido, and again, the connection comes from within our trusted execution environment, and then you can start the process with with your passport photo page or with a driver's license, with the identity card, and in the end, you can get access to. Oh yeah, I can't do it because I'm on my laptop. But if you want to play around with it, this is live, so you can just access it and play with it. Do a couple of verifications, and then see how you can do the KYC process, so that the KYCing would actually also sit within the enclave, which is a very nice solution to the problem of how do you prevent the central bank to get not just everybody's transactions, access to everybody's transactions, but how can they actually append personally identifying information to that. Now there's the identification attacks, we are aware of that. And I think the result of CBDCs will be that there is going to be a shift in the privacy domain towards a little less privacy and a little more auditability, which is something that needs to be discussed with the central banks, how exactly to design it. But with our system, at least, we can show that the KYC information can be made available to authorized addresses only, for example, a court, and not to the central bank or to unauthorized government entities, which is always the risk in any of these centralized systems. So I'm going to skip this, the system's description, and I think I have like 2 minutes for questions and comments that I would take from the chat if all goes according to plan. All right, so cool. Here's one question. Does law, including the international standards such as FATF recommendations, the AML and the travel rule, append technology solutions ensuring more privacy regardless of the design? No, I think the design and the legal solutions, they are very deeply thanks. They're very deeply interconnected. You can't design a system that shifts the privacy frontier and then expect governments to not use these new opportunities. So I think the better approach is to design systems with these checks and balances in mind right from the get-go, so that some things are not actually possible, even though the government would like it to be. And we think with the wallet design that we came up with, you overcome two of the key issues. You can guarantee some form of privacy, not anonymity, but privacy, because all the KYC information, the personal information, is behind the enclave, unavailable to prying eyes. And at the same time, you overcome this issue that 50% of people just don't have a smartphone, because they can use their QR code, walk up to one of the connectors, and then they can start buying CBDC if a CBDC becomes reality, or even investing in private crypto if they want to. And I think this is one of the few ways that scales to really bring crypto and then CBDC ultimately to the masses. And with that, I hand over back to the green room, I guess.